morning, everybody, and welcome to the call. We all are waiting patiently to look at in terms of how the budget is going to impact us in terms of the change and deciphering it better as and when we are getting more details. So let me welcome you all. Let me first begin by introducing myself. My name is Manish Mehrotra. I'm the Zonal Head for West for Private Wealth Management. And I have been with the company for 13 years and with the market for 30 years. Let me also introduce my other colleagues. So Mohit, if you can just raise your hand. So we have Mohit Gulati. Mohit is Zonal Head for North. Mohit is again basically an industry veteran. He has been with us and ICICI Group for over 2 decades and one of the very known and prominent names in the market. We also have Sanjeev Arora. Sanjeev, if you can raise your hand. Hi. So that's Sanjeev Arora for you. Sanjeev heads our East business and he has been with us, and prior to that he was heading a very significant portion, stand chart for a very long time. We also have Amit Gupta. Amit, if you can raise your hand. Hi. So Amit is a known veteran in the market. You all would have seen Amit more often on TV. He's a president awardee for his best research capability on derivative side as well as basically on technical side. He also runs one of our PMSs, which incidentally is one of the best performing PMSs in the market. I'm sure some of you may be following PMS Bazaar, and you would have seen that ACE PMS managed by Amit is one of the best PMSs. And we have Mr. Bharat Parekh. Bharat, if you can on the camera.
Hi guys.
Thanks. So again, Bharat is a very well-known name in the market. So Bharat started his career with Prashant Jain as basically person advising him on HDFC AMC. He was there for 12 years along with Prashant, and he was part of creating some of the very big stories which are there. Post that, he joined Reliance and he was managing one of the biggest HNI's money, which is one of the largest and most prominent HNI. I'm not taking names, but the money he was managing was 75,000 crores. He heads products for us. So that is a brief introduction. We have Mr. Nilesh Shah, who has just joined us. Nilesh bhai, if you can on your camera. Hey, thanks Nilesh bhai. So Nilesh bhai doesn't need much introduction. One of the industry veterans. He's part of very important forums. He has worked. In fact, incidentally, he started with Templeton, then worked in ICICI. So some of the things which we are doing in ICICI AMCs, the neve of that was kept by Nilesh bhai. Then he moved to Kotak, and obviously he has taken Kotak to new heights. He's part of Prime Minister's Advisory Council as well. So we are very fortunate to have Nilesh bhai here. We also have Kishore Rajwani. Kishore heads our South business. He has been industry veteran as well, and he has been with us for 2 years. So Bharat will be anchor for our event today. Bharat, over to you.
Thank you, Manish, and welcome Nilesh bhai. I think it's wonderful to have you here. I'm sure, and first of all, thank you for coming on this channel and spending time with us. Nilesh bhai, without wasting much time, I'm sure a realistic budget, capital focus budget, numbers are credentials. Your disinvestment numbers are achievable. 10.5% growth is good. 5.9% fiscal consolidation. Comment that 4.5 will be achieved. I think all good, great stuff. What's there for our investor in this particular budget, which we need to really look at, and how this is going to change our life and to what extent?
So, thank you, Manish bhai. Thank you, Bharat bhai. The best thing in the budget is that it reassures investors that India growth story is moving forward. There could be debate about the speed, but not even the worst critic of India will say that our growth journey is moving ahead. For years and decades, we were bogey of global growth train. Now we are the engine. हम चलेंगे तो दुनिया चलेगी, हम रुकेंगे तो दुनिया रुकेगी. And this is best illustrated by the fact that from 1947 till 2013, what we built by way of infrastructure, which creates growth impetus in an economy, we are now building or proposing to build between 2014 to 2024. 67 equal to 10 is the equation which is turning out to be correct in Indian infrastructure context. We had 80,000 kilometers of highway in 14. Now we'll have 1,65,000 kilometers of highway in 24. We had 2,25,000 megawatt of power capacity in 14. We'll have 4,35,000 megawatt of capacity in 24. We were mining 600 million tons of coal. We'll mine billion tons of coal in 24. 67 equal to 10 is happening in Indian infrastructure, which gives confidence to investors that yes, India growth story will continue. India has moved from 10th largest economy to 5th largest economy between 2014 to 2022. And it will go to 3rd largest economy either in 28 or 30 or 32.
So Nilesh bhai, it's a great long-term story, no doubt about it. But from the fifth point of view, and the fact is that even though this is a last full budget from this current government, and lot of, you can say next government will be what and all, but broadly for this particular government, this is the last full budget, and they stayed away from the populist measures. We can term some of those announcements as a populist, but considering that the amount spent on those are so small and there is nothing which is really putting a dent into the fiscal, you can broadly say that it's not a populist budget. Now there are two parts in that particular story, Nilesh bhai. One, the fact is that they have tried to give something more to every individual by way of tax savings. So whether it is high net worth individual where the tax rates have effectively been brought down, or up to the 15 lakhs earners where they have tried to create a architecture which will have some more money in that point. Now from that point of view, how do you see, is that going to make a material difference, or it is more optical than anything more?
So Bharat bhai, there are only 55,000 people who pay 43% of tax. Now, if it becomes 39%, will it going to change my behavior? Answer is no. When my tax rate went up, I didn't reduce my consumption. I didn't have the guts and neither the need to tell my wife that आज एक साड़ी कम खरीदना या 50,000 रुपए की साड़ी मत लेना, 30,000 रुपए की लेना, because मेरा tax rate बढ़ गया है. ना हिम्मत थी, ना जरूरत थी. So the rich guy's consumption pattern is not going to change because of taxation movement. But the good part is that there is tax savings for lower middle class also. Out of 35,000 crore of tax savings which budget has proposed, more than 70 to 80% is going to accrue to about 1 crore taxpayers. And for them, this savings may mean spending. They will buy a bike. They will probably go for a holiday. I hope they go in India and not abroad. They will go and probably, spend money on some 5-star dinner. But this is the community which will spend money, and we require that consumption boost in the economy. Our economy has 3 challenges. One, unsustainable current account deficit and balance of payment deficit, subdued consumption, especially at the bottom end of pyramid, and subdued private sector investment. This budget is pushing private sector as well as government investment through infrastructure allocation. And it is trying to resolve subdued consumption by providing this tax incentives.
Nilesh bhai, on the same point, the fact is that if you look at the nominal GDP growth number, which has been projected at 10.5%. Now, if you look at the past growth and all, I think at 10.5% nominal GDP growth, do you see that it's also factoring that we may not have a same strength of growth? And sure, all of us broadly understand, and a lot of our clients who are there on the call, may not correlate with this. The fact is that the growth will be lower, right? It will be still one of the largest in the world, but it is lower. Inflation will be lower, but still, much higher. But overall at 10.5% growth, which also indicates that there will be pressure on some part of the economy, and that can also broadly, may reduce our consumption. And that a potential risk to the earning, in your opinion, that if the growth is at 10.5%, and fact is that, consumption may get hit because of the nominal growth rate. Do you see any risk on the consumption story from that point of view?
So in economy as well as in market, never say never. Anything can happen. In Feb 20, if you had asked me, will COVID-19 spread around the world, I would have said no. And I would have been spectacularly wrong. 10.5% growth rate is assumed on a conservative basis. CSFB is assuming 12% GDP growth. If we add the higher range of GDP growth in economic survey and inflation, it will probably go to somewhere around 12% also. So my feeling is that when we are assuming 10.5% GDP growth, it is on a conservative estimate. And there is a reasonably good chance that on a status quo basis, it will get exceeded in FY24. However, if there is untoward incidents like Russia, Ukraine, like COVID, like Delta wave, then undoubtedly growth will suffer. It is also important to keep in mind that global growth is slowing down. In that scenario, our exports can't pick up. Anyway, we are the only odd man out in the entire world whose market share in global GDP at 3.5% is higher than its market share in goods export at 1.85%. दुनिया दूसरों को टोपी पहना के आगे बढ़ती है, हम खुद टोपी पहन के आगे बढ़ने की कोशिश कर रहे हैं. So in a slowing global growth, it will be difficult to pursue higher growth. And I think moderating growth is good from a macro stability point of view. Let's hope and pray there is no energy shock, there is no COVID shock, and that will ensure that we should be able to cross 10.5 in FY24.
Thanks, Nilesh bhai. This continuation to the point which you mentioned, which is the CAD, and the fact is that, external, because I think a very large portion of our import is also, dominated by gold. And I think there was one very interesting change in the budget where they're saying that the conversion of the physical gold into the e-gold, and that, vice versa, the cost of acquisition will be the earlier one, which also means that there is no capital gain incidence on conversion of physical to digital. I think these two schemes of government, which actually not worked. The first one was that they came out with this new tax regime, and I think it was hardly any taker for that. And they tried to revisit it and do it. Other is that gold scheme. They thought that India may have a 25-30,000 tons of gold in the country. If we can get converted into gold, and actually they can, to great extent reduce the import of gold. Any thought on that? Will that make a difference, and will this scheme again come to the limelight?
So I'm reasonably pessimistic about success of this scheme. Bharat bhai, neither you nor I am aware what jewelry our wives have. I'm staying with my mother for last 54 years. And I still don't know how much gold she has. Do you think our wives, our sisters, our mother will convert their gold into e-gold? If anyone is assuming that, that will be really, really outlandish assumption. The second thing, a lot of gold, which you talked about, is held in tijori and in bank safe deposit lockers. It's not in white book. Why will people convert their black gold into e-gold so that government can track it down and demand tax from them? You remember there was a time when there was wealth tax in India. Yes. And the cumulative wealth tax paid was less than the administrative charges on wealth tax collection. Why did that happen? Because people were not disclosing their gold. So it's a good step on paper, but in the Indian psyche, I doubt if it will be successful.
Nilesh bhai, even to this temples and all those things, they will not be to pursue them and agree to this?
So temples, yes, they could convert their gold into e-gold. Plus, please remember that there are very few temples which have large amount of gold. There will be temples like Padmanabha Swami temple where traditions will mean that you can't open vaults and convert your gold into e-gold. There will be lakhs of temples and religious places which require jewelry for the idol. They won't convert that jewelry into e-gold because it is needed for idol worshipping. So the success of e-gold will be fairly limited. It will be for institutional players, but bulk of the gold owned by India and Indians is in retail and in parallel economy.
Right. So Nilesh bhai, now looking at this particular budget and the fact is capex, what's your take? Which sector where the next 1 year will be? Is there any tilt or change in your tilt towards a particular sector? And this one, we heard about capex, we heard about 10 lakh crore expanding. We talk about railways. So what's your feeling? Where is this money moving, and what can be really good opportunity run up to the budget or beyond budget?
So Bharat bhai, you have to take a call ahead of event, not after the event. You can make adjustments depending upon whether you were right or wrong. Ahead of budget, we were reasonably confident about increased allocation to infrastructure. Of course, we never expected it to reach 10 lakh crore, but we were overweight infrastructure, construction, materials, and capital goods sector. That call continues to remain valid with this enhanced allocation and speedier execution thanks to the election and G20. One sector which we are positively evaluating is FMCG. Ahead of election, government puts more money in the hands of consumers, especially at bottom of pyramid. Their spending propensity is higher than saving propensity, so rotation of money happens. Both this will result into higher demand for consumer staples which are required at the bottom of the pyramid, from liquor to food to so on and so forth. We believe over next 18 months, FMCG consumer sector will be market outperformer.
Understood. Manish, Mohit, anybody have any questions? Because I can continue asking Nilesh bhai, but if you guys have any point, please do chip in.
Sure, Sanjeev, you had a question.
Yeah, thank you, Manish. Nilesh bhai, thank you for I think giving us a brief. My question was that on green growth, the government has had a one of the between the Saptarishi 7 priorities. I think green growth is one priority for them. If you could elaborate on this, what are the possibilities and outcomes that we see of the government wanting to kind of pursue the green growth?
Sanjeev bhai, as an Indian, when I complain to God that Bhagwan, हमारी लेफ्ट साइड में सबको आपने ऑयल एंड गैस दिया, राइट साइड में सबको ऑयल एंड गैस दिया, फ्रॉम म्यांमार टू इंडोनेशिया एंड फ्रॉम यूएई टू सऊदी, खाली हमको ही ऑयल नहीं दिया. तो भगवान सेड दैट भैया ऊपर देख, वी हैव गिवन यू अनलिमिटेड एनर्जी. India is blessed to have almost 12 months of solar energy. And we have areas in Rajasthan and Kutch which are not densely populated. We import $100 to $150 billion of oil and gas every year. Thanks to all the hardworking Indians in Middle East and other places, remittance comes and helps us balance out our energy bill. अपना पसीना बेच के हम oil खरीदते हैं. But now in this budget and outside of budget, government is focused on green energy. It serves multiple objectives. One, as the most highest population nation in the world, we need to take care of environment. By moving from fossil fuel like oil and gas to green energy, we will truly prove Vasudhaiv Kutumbakam. Second, we will save on this $100 to $150 billion of import, which is likely to keep on going up. Third, as the top 3 consumer of oil in the world, if we can reduce our consumption, it will also help lower the prices. Finally, we are taking advantage of what is abundantly available with us, that is solar power and water, where through electrolysis we can convert this into hydrogen and power our energy need. In the global oil and gas consumption, our share is fairly low in relation to our GDP. But in the new age hydrogen consumption, our share is higher relative to our GDP. That means we have already embarked on this green energy journey ahead of other people. 2 of our best entrepreneurs, Ambani Group and Adani Group, are working on green hydrogen. We have ingredients available, we have technology available, we have the need, we have a large domestic market. And now government is incentivizing people to put all these things together. Imagine an India where oil and gas consumption is low, imports are low. We have used local materials like solar energy and water to power our energy need. It's less polluting. This is the India in which we all would like to live, isn't it?
Thanks, Nilesh bhai. Nilesh bhai, there's a one
Thank you.
question, and I think it's an interesting question, and I thought I'll take it. Is that there is a change in the taxation for insurance companies, and you've been one of the vocal guy asking about the parity and all. It came in. Your take that this will now outcast the insurance companies' investment products may not be the one flavor in terms of the HNI segment as well. Now, the change and what you see as an implication of that, there's a big, cut in the prices of insurance companies as well, which is getting reflected in the stock price. So your take and the implications.
So, Bharat bhai, insurance is protection industry. India is underinsured. And the growth potential of insurance industry doesn't diminish with what has been proposed. Every Indian will need term policy. They will need health insurance. They will need general insurance. They will need accident insurance. The growth prospects of the insurance industry doesn't get diminished at all by what has happened. The proposal is impacting policies issued to high net worth individuals from 1st April 2023. It was a tax arbitrage which was allowing high net worth individuals to convert interest income into tax-free gains. This arbitrage needed to be plugged as we have to improve our tax compliance ratio from low single digit to high double digit. There is a one-time impact on stock prices of insurance companies, but as an investor, it does not diminish my outlook on the insurance industry as protection provider. This was arbitrage available for a while. If not today, tomorrow it would have been stopped. And this does not diminish insurance industry outlook.
Nilesh bhai, see, in the same context, tomorrow a banker can go to the finance ministry and say, sir, I give a 5-year cumulative deposit scheme, which is taxable in the hand of the individual. In the mutual fund, if you invest, they get a long-term capital gain. So again, there is a tax arbitrage. So do you think that broadly over a period of time, if you earn an interest income, you need to be prepared to pay tax on every penny of what you earn?
Undoubtedly, there should not be any arbitrage between any service providers. At the same time, I will also propose to Finance Ministry that banks today benefit from implicit credit guarantee of government. When Yes Bank went down, there was intervention by Government of India. When Franklin Templeton put freeze on the redemption and was under pressure, there was no bailout required. How much money has been invested by Government of India into banking sector to bail out against all the NPAs? The implicit credit guarantee given by Government of India is far more than the tax benefits given to mutual fund industry. Let there be a level playing field where every service provider in financial services industry either has explicit or implicit guarantee. Please charge for that implicit guarantee and take away all the tax benefits. Let the merit win.
Fair. And I can't allow you go without asking a debt question, Nilesh bhai. The fact is fiscal deficit consolidation happened. The fact is that the numbers are looking good. What's your view on the fixed income? The fact is, interest rate is close to the peak. Obviously, we have a MPC meeting, down the next week. FOMC was yesterday night. What's your take on the interest rate and how do you look at this part of the asset allocation?
So, Bharat bhai, our interest rate policy will be influenced by global as well as local factors. On the global side, US Fed is walking left and talking right. They are suggesting that there will be 2 rate hikes of 25 basis points each over and above what happened yesterday. Market is saying that no, there will be only 1 rate hike. I believe Fed will do 1 hike and then probably peak out. Market is also expecting Fed to cut rates by end of the year, which Fed is resolutely denying. I believe market will be ahead of the Fed and we will see interest rates peaking out in US by mid-23 and on the way down by end 23. On the local factors, inflation is under control thanks to lower oil price, lower coal price, lower food price, and fiscal consolidation. The size of the borrowing program at 11,90,000 crore for net is as per the expectations of the market. But we will require support of RBI through open market operation for a smooth passage of this borrowing program in a non-disruptive manner. If RBI intervenes through OMOs, I believe in the first half of CY23, 10-year yield will range between 7.25 to 7.5. And in the second half, it will range between 7 to 7.25. We will exit December 23 10-year yield at a reasonably lower level than what we entered in Jan 2023. This means investors should put money in medium to long duration, long maturity debt products. Bond funds, gilt funds, long duration funds will all be appropriate for investment. And the returns from debt fund, thanks to the coupon plus capital appreciation, will be probably higher than what you can expect from equity funds in the near-term horizon.
And the last part of the asset allocation is gold and silver. And I really want to know your view. How do you, because the 3 parts of our asset allocation, debt, equity, and gold. And if you can just share your view on this 2 parts of the asset allocation.
So gold will also have local and global factor. Globally, I believe gold is on the up move, partly driven by central banks' purchase, which last year purchased maximum quantity of gold in their history. This is driven by Russian experience. The day before Ukraine invasion, Russia was sitting on $650 billion of FX reserves, $500 billion in securities, $150 billion in physical gold. The day after Russia invasion of Ukraine, they were left only with $150 billion of operative FX reserves. 500 got frozen overnight. With this experience in mind, no rational central banker in the world would not like to keep money in gold. This has already happened in CY22 with everyone buying gold and adding to their portfolio. This has pulled gold prices to current level. CY23-24 will be no different. Central banks around the world will build sufficient reserves of gold to tackle what happened with Russia. Silver stocks also have dwindled as there is commercial usage for the silver. The mining costs have gone up, and put together that puts support to silver and gold prices. I believe from a dollar price point of view, both silver and gold should have a good year in CY23. The big local factor which is negative is the import duty and GST. There is 16% tax incidence on gold and silver. This has encouraged gold smuggling. Today in Mumbai market, you have 3 to 4% discount available for bulk buying of gold. This is the benefit probably gold smugglers are passing for faster turnover. At some point of time, government to discourage gold smuggling will reduce tax incidence. Be mentally prepared to lose 16% of your gold portfolio in one day if tax incidence becomes zero. Now, we do know that tax incidence won't become zero, but there could be anywhere between 5 to 10% reduction in portfolio value of gold because of this tax change. So I will recommend do invest in gold and silver. The first option might be via LRS, where you can buy gold and silver in offshore market, no tax incidence. Buy sovereign gold bonds because you do get 2.25 to 2.5% coupon income. And that coupon income will take care of any reduction in import duty or tax incidence. And keep some dry powder otherwise to buy once import duty come down.
Great, great, Nilesh bhai. Nilesh bhai, there's one question. Will recessionary talk in the world be spoiler for India growth story?
Sorry, which one?
Will recession talks in the world be spoiler for India's growth story?
नहीं जी, अगर बाकी लोगों की शर्ट ब्लैक है तो मेरी ग्रे शर्ट भी व्हाइट में गिनी जाएगी, और बाकी लोगों की शर्ट व्हाइट है तो मेरी व्हाइट शर्ट भी ग्रे में गिनी जाएगी. So we need a smaller line below us so that our line looks bigger. The world in recession is the best for India. It should be mild recession, not severe recession.
So Nilesh bhai, there is a follow-on question from one of the investors. He's saying, what's your view on US? Is it recession or is it stagflation?
I don't think so. US is going into stagflation. Their growth rate has come stronger than expected. Drop in inflation is faster than expected. And most importantly, US has fantastic set of innovation. It still attracts best of the talent. It still has best of the education system. And it still is a meritocracy society. Put all these things together, stagflation in US will be a big shock. I think it is not even a mild recession. And we will see US turning around with Fed right now in a slightly comfortable position to reduce interest rates because inflation is dropping faster than expected. The recent rally in US market probably also represents that expectations.
Okay, people were willing to write off UK at some point of time, saying that things are not looking good in Europe and UK. Now, suddenly, in terms of markets, they're almost touching the pre-COVID levels. So what's your view there? Is there any improvement or it's only market is retracting?
So on UK, I have limited knowledge. But if we look at on a broad basis, which are the industries in US which we can think of? We all think UK is more of a tourism place than is industry place. When I traveled from London to Scotland long ago, I didn't really find any industry like we find when we travel from Mumbai to Gujarat or Mumbai to Pune. My feeling is that UK was a financial services industry, tourism industry, real estate industry. It grew because it allowed Russian oligarchs to set up their base in London and take out money from Russia and other emerging economies into London. but they didn't really develop the industrial base or innovation base. Think of any technology product like Google, like Alphabet, like Meta, like Amazon from UK. There's hardly any innovation. So put all these things together with my limited knowledge, I will say that UK is not necessarily the best market to invest into. Europe, there are certain exceptionally good companies. German engineering is impeccable. German automobiles, we will all prefer to drive German automobiles. There are some French technology company and energy company which are fantastic. So I believe Europe, there will be better opportunities. UK, there will be far less opportunities.
Okay, my second question is basically a slightly political question. They're saying normally we would have seen much of populist budget, given that it is the last budget of this term as a full-fledged budget. But is this also signaling a very confident victory for them? Because I'm saying there's not much populist measures which they could see.
Manish bhai, again, there are multiple ways to interpret this, but I will interpret that it shows voters' maturity, that they are no longer voting on the basis of populist measures like free food, like free television or free mixture grinder. People are now voting for growth, development, jobs. The person is interested in securing a better future for his or her kid than getting a free television or mixture grinder. And this maturity of voters to vote for more pressing issues is, I think, behind the budget, where the focus is on creating infrastructure and growth multiplier rather than giving what Prime Minister calls revenue.
Sure, thanks. Mohit, you had a few questions on you.
Nilesh, I think I don't know whether this also is a continued
question.
political question. A large conglomerate currently, has, created a kind of hassle in the equity markets. Do you think it has a cascading effect to other places as well, other, sectors as well?
So Mohit bhai, there could be temporary effect because of such noise. If you remember, when Satyam news broke out, it was a shock to investors. But did it alter the trajectory of Infosys, Wipro, TCS, HCL, Tech Mahindra in the same sector? Answer is no. Those companies continued to grow, albeit for a day or two. When Satyam news came out, there was an impact. Same way, this large conglomerate news will have short-term impact at best, but won't have any material impact on long-term basis. And more importantly, here we are talking about valuation. We are not worried about the business. As a consumer, I have seen Mundra Port, I have seen Mumbai Airport, I have consumed Ambuja ACC cement, I have used Fortune Oil. So I'm able to touch and feel the businesses. There's no doubt on that. There's no worry on that. It's all about whether the valuation of this business is reasonable or not. My feel is that as water finds its own level, at valuation, at comfortable valuation, businesses will find their bottom.
Also, in terms of maybe, where the question came from one of the investors was maybe because, a lot of Indian banks would have also lent to, in such a situation, whether, it can create a cascading effect there to the banking system as well.
The total debt of Adani Group is less than the debt of a telecom company, which is in much dire state. Now, if we are worried about cascading effect, let's worry about telecom company, not about this group. More importantly, the total exposure to the group, as per SocGen report, is about $10 billion. That's 0.06% of the banking exposure. And as I mentioned, all of us have touched and felt the businesses of this group. There are assets, there are cash producing businesses, there is sufficient capacity to service debt. Now, just because there is some bad news, there is some controversy, why do we assume the worst?
Right.
Amit, you had few things for Nilesh Bhai and your observations.
Yeah. So, Nilesh Bhai, actually, if you look at from the borrowing angle of this government, because I understand the fiscal deficit, everything is on the gliding path. And we have seen that the GDP forecast also is lower, but the government is not going for borrowing more. So do you think what they have pointed out of the savings, small savings, they will garner, more money? So that is the right way actually they can go, or something else, they can fall short actually in that?
So my feeling is that the small saving collections have been receding in FY23 over FY22 and will recede in FY24 over FY23. The government has cushion on tax revenue like this year and next year. The 10.5% growth for tax collection, both direct and indirect, looks conservative. This year's run rate is 18. 18 probably will become 12, 13 rather than 10.5. So there is ability to pay for extra expenditure, which generally happens from extra revenue. That means fiscal deficit and funding of fiscal deficit will more or less remain as per the budgeted estimate like current year. And 66% funding of fiscal deficit from market borrowing and 33% from small savings and other borrowings looks reasonable to achieve.
Yeah.
Nilesh Bhai, also any particular sector which you like, which will benefit post-budget scenario, given that this is a very mature budget, as you rightly said, but there'll be certain sectors which will be slightly more bullish, like banking was previously the best portion. Is it continuing the same fashion? We were fairly bullish on auto and some other sectors. IT looks a beaten down sector. So if you can just throw some light for the benefit viewers, it will help.
So in the near term, over next 12 to 18 month horizon, we believe infrastructure will do well because of extra allocation and speedier execution. Over next 12, 18 months, FMCG should do well as poll-bound government and political parties put money in the hands of bottom-end consumer, and their spending propensity will be higher than saving propensity. But if you take Manish by 10, 15, 20-year view, what is that big trend emerging in India, like generic pharma, like two-wheeler production, like IT services industry? If you look at IT services industry, we had engineers, we had program writers, we have coders. We brought that raw material to first create Y2K solution. From that door, we went into infrastructure management and application maintenance. From there, we moved into product launches. From there, or along with that, we moved into BPO and KPO services. And from there, eventually, we moved into AI, machine learning, robotics, and digital ecosystem. This is the journey which helped create TCS, Infosys, Wipro kind of giants, which employ 3 lakh employees, 4 lakh employees, 5 lakh employees. What is similar happening in India? We have best of the doctors in the world. In fact, in UK's national health system, a substantially large part is made in India. In US, 1/3 of doctors are of Indian origin. In medicine, we have remarkable quality as well as cost advantage. 45% of medicines consumed in America is made in India. We also have PLI scheme for medical equipments, and many medical equipments comparable to the best in the world is now manufactured in India, operated in India. We have nurses. The world is in so desperate need of nurses that in most embassies today, you will find a special VIP line for nurses and a non-VIP line for commoners like you and me. We just need someone to get all these raw materials together, nurses, doctors, medical equipments, medicines, and provide healthcare solutions. It will be provided digitally as well as physically. It will be provided in India as well as outside of India. Will there be a day over next 15, 20 years where there will be one giant employing 50,000, 1 lakh medical professionals and taking care of aging world, taking care of world which has more need for healthcare? The next giants in this field will come out of India. And they are required not only for India, but also for the world, which requires affordable yet quality healthcare. So if you are taking 15, 20-year view, if you want to play on the trajectory of technology giants in India, healthcare is the sector to be in.
Sure, thanks.
Nilesh bhai, one question I had. So we are focusing on manufacturing in India, right? But along with manufacturing, there is also automation which happens. So what job creation we are saying can happen in manufacturing? Is it possible? Because this budget government is talking about a lot of focus on tourism, right? So they are saying, so they in the Saptarishi, they have this unleashing potential, one of the thing. So I think unleashing potential can be there in tourism. So job creation can be higher in tourism when we are looking more into manufacturing?
Undoubtedly, for our car to run, we not only require manufacturing, but also services to provide jobs. We have 140 crore Indians, so we need both the things to fire. And what do we not have in India? From mountains to deserts to beaches, from 5,000-year-old civilization to modern civilization. We have everything. And now our airports are better than Western airports. There is reasonable security. There is reasonable culture. And Atithi Devo Bhava is ingrained into our system. Unfortunately, 1.5 crore Indians travel abroad for tourism. And only 50 lakh people come to India for enjoying our hospitality. We need to develop our tourism sector, not only for domestic tourists, but also for global tourists. And the change is happening. Earlier, Goa, Kerala were preferred destination. Now, I believe Varanasi as a holy town has received more tourists than the state of Goa. We have to increase domestic tourism because it will create jobs where people are staying. They won't have to migrate to urban areas. And to create tourism sector, we as citizens also have to contribute. We have to keep India clean. That's why Swachh Bharat is necessary. And Swachh Bharat will be successful not because PM Modi has launched, because you and me will keep India clean. We also have to provide security to tourists. We also have to ensure that they are not taken for a ride. If this Atithi Devo Bhava truly develops, tourism sector will create far more jobs and it will employ people at their place of residence rather than creating migration.
So just adding they are talking about 50 more airports in India, which will also add on to this tourism part. So is it possible one of the most underperforming sector, airline, that can start coming up, though we have very limited listing over there?
The business and market could be totally different. In airline, I'm more of a believer of what Warren Buffett said, that if someone had shot down Wright brothers, so many investors would not have lost money in aviation sector. Aviation sector has grown, but aviation investors haven't made money because there is no barrier to entry. You can lease aeroplanes and start flying airline. Because of that low barrier to entry, aviation industry has generally been not profitable and rewarding to investors. Of course, there are exceptions. So if you are investing in an exceptional airline, you can make money. But by and large, the rule is that in aviation industry, it's difficult to make money.
Yeah.
Nilesh bhai, one question. This is basically regarding the real estate sector. So how do you see, going forward, especially points on how do you see the housing, and housing also 2 points. How do you see the affordable and the luxury segment? So what's your view on this?
There is a body blow to luxury segment, and I define luxury segment as above 10 crore housing. If someone was staying in, let's say, a 20 crore market value house bought by his father, and now when he wants to sell and buy into a new house at 25 crore, suddenly he realizes that he can get tax exemption only for 10 crore. Rest 10 crore gains he has to pay. Suddenly his 25 crore house has become 27, 28 crore. He needs to be compensated for taking that hit. Either it will be in form of lower real estate prices or lower transactions. So there is an impact on luxury segment above 10 crore houses thanks to the change in the budget. The good part is that those transactions are fairly limited, mostly in urban areas. The affordable housing scheme, on the other end, has got a boost because of Pradhan Mantri Awas Yojana. It's building houses at a rapid pace. The overall surplus in the hands of upper middle class and rich Indians is also encouraging real estate industry. Last month in Mumbai, we had second highest registrations. So overall, I believe real estate segment will have two trends: top end luxury getting lower demand or lower price realization, and the bottom to middle end seeing higher traction in terms of higher prices as well as higher traction.
Sure. Thank you. Yes.
Yeah, Amit, you were saying something.
No, I was thanking Nilesh Bhai actually. I think very apt answers to the questions and very, very, very elaborate also. So thank you. Thanks, Nilesh Bhai, for the answer.
Thank you so
Thank you,
much.
Nilesh Bhai, for this. And maybe with your permission, Nilesh Bhai, I will ask some questions to Amit as well.
Bharat Bhai, I'll have to leave because there's a back-to-back.
That's the reason why I switched on to this. Thank you, Nilesh Bhai. That was the reason I said, if with your permission, thank you for time. I'll have some more question for Amit before we wind up. Thank you. Thank you for joining.
Thank you so much.
Thank you. Thank you. So, Amit, if you can just share your thought in terms of the sectors and all, maybe in 5 minutes, and then we can have a questions from the audience, guys. Amit is there on the call. He is managing our PMS Ace Equity, and he can give us more insight into this specific sectors and specific stories. So, your nutshell, your take on this, Amit.
So, Bharat Bhai, if you look at the start of the budget, it was from Saptarishi, which is guiding through the Amrit Kaal. So I think if you look at those 7 points, that will cover up the sectors actually alone. If we can look at one by one. So for example, they are talking about reaching the last mile. In reaching the last mile, we have seen that the government is trying to focus on one of the laggard space, which is agriculture in India. After the pandemic and because of higher inflation, we saw that this segment was under pressure. Whatever results were coming from FMCG companies, we were seeing that kind of pullback is not coming, is missing. -9% of degrowth, which was happening in the rural space. Now they have started talking about, giving the agricultural credit, and the increase is of 11% to 20 lakh crores. So my sense is the PSU banks, because they have a good reach towards the rural areas, I think that is one segment which can benefit because of this. So I think that is a takeaway from that Saptarishi thought. And I think another takeaway is they are talking about unleashing the potential. So which I was discussing with Nilesh Bhai also, the job creation. So I think tourism and manufacturing. So these two are the areas where government is focusing more for job creation. And tourism, where airline comes, where hotel comes, where all the ancillary industries comes. That is where we need to, go down and start doing the bottom-up exercise now, because they are talking about opening 50 nodal centers for tourism in India. And they will be opening 50 new airports. So you are seeing more regional airports opening up. It is easy for the people to move from tier 2 city to tier 2 city. I'm not talking about metros actually. So if that happens, then I think tourism, which is there in tier 2 and which is there in Himalayas or, so I think the reach of the people can enhance. So along with the consumer space, which will benefit because of job creation, my sense is we can find opportunities in the tourism sector also. So what the bottom line is, please pick those sectors or those stocks which are reasonably valued, because money is not going into very rich stocks now. That is very clear. We are seeing, even if China is performing or Hang Seng is performing and they moved up by 50% since October, we have not been able to perform because we are relatively expensively valued than those markets. So though dollar has topped out, money is coming, but money is coming into those pockets which are reasonably valued. So you need to identify that. So manufacturing, again, PLI benefits, more benefits given to sectors. So I think that is throwing a lot of opportunities along with the capital goods. So capital goods, I still remember in 2004 to 2007, this particular sector had a dream time. The whole infrastructure sector actually became 4 times in that particular period, which has not happened, which is not been doubled yet. So that is where, when the government focus is there, and frankly, when we had a word with a lot of analysts in the market, none of them was expecting 10 lakh crore of capital expenditure by the government, because everyone had this point that nominal GDP growth will remain around 10.5-11%. The global headwinds are there. How will you reach to that capital expenditure target when the elections are also there and you have to spend for social welfare also? But this is where this budget is really good. The numbers are realistic. When they are talking about 10.5% of tax revenue growth or GDP numbers, I think it's very realistic. When they are talking about disinvestment target of 51,000, I think it's very realistic. In fact, 65,000 crore of disinvestment target in financial year 23, it has already been brought down to now 50,000 crore. So there are companies now in the shipping space, in the BEML kind of stock. Now you have IDBI, Concor, all of these are there in the pipeline where either the strategic sale or the disinvestment are going to happen. And the zinc is another space where that is going to happen actually. So you have sectors, your stock picking in the reasonably valued stocks is required now. And I think that is what I can say. Yeah, thank you.
Thanks, Amit. Maybe basically if you can also touch upon some other ideas, strategies which look good from your perspective, especially in equity.
So let's focus on the core area where the government also was focusing more. So CapEx. When I look at CapEx, it was 7.28 lakh crores in financial year 23. And look at the segments where the money was going. So we had 22% allocation into railways actually that time. And this time, when the CapEx has moved from 7.28 to 10 lakh crores, it is not 22%. It is 24%. So your base amount has increased and your percentage allocation has also increased into railways. So this is very, very important to understand. It's a growth of 50% when I look at the railway allocation from 1.6 lakh crores to 2.4 lakh crores now in this budget. And why it is happening? If you remember, there was a new logistics policy actually came out just few months before. And the government started talking about that if they have to push the movement in the country, they need to reduce the logistics cost. Because in order to make your manufacturing competitive, bringing down logistics cost is very, very much required. That is what the government has understood. And it is high. If you look at it, it is 14% of GDP. So the government has targeted 8% of GDP, and that is where they are focusing more on rail tracks. They are talking about railways expansion, the freight prices, whatever, but they are trying to move the goods through the railway tracks. So you can see that this dedicated freight corridor, they have decided the date around mid of 2024 when it will be ready. So I think railway is one segment. The ancillary components around railways can be looked at when we are forming our equity portfolios. So there are a number of stocks in capital goods which are related to that. There are a number of stocks in some of the bearing companies, for example, which are related to that. There are a number of MNC companies which are related to that, and that possibly you can, I think, identify. Another space which has continued with the allocation. So we had almost 2.08 lakh crore in financial year 23, and now it is 2.6 lakh crore in financial year 24. It is roads, highways. So we are seeing the road construction companies where the balance sheets are almost deleveraged. That is one segment that you need to look at. So whenever such corrections are coming in the market, which has come now because of some other non-fundamental reason, then I think that is a time when you need to look at those companies in the road construction, which have come down and the valuations are better. And obviously their balance sheet should be much deleveraged, that a cash flow component should be higher. So that is where very few companies are there, but that is what you can focus in the road construction area. The third segment was defense. So there is some disappointment from the people because the defense budget was 1.5 lakh crores in financial year 23, and this time it is 1.6 lakh crores. So there is a surge of 8% around in the defense budget. And that is why we have seen the profit booking has come in the defense companies in the recent period. So again, this is a trigger which has gone there because those companies were very, very richly valued. We have 90% companies in the defense in India, which are PSUs. And PSU companies generally don't trade in the premium valuations, which happened actually in the recent times when we saw it. So where is the opportunity now? So I think the opportunity goes into the private companies now because those PSUs can remain under pressure for some time till the valuations are not getting better. So I think the private companies in the defense, which are trying or they have a good setup for the last 10 years around, that you can target. And there are companies, actually 1 or 2 companies in that space, which have not been performing for the last 7-8 years. They are coming out. And that throws an opportunity now in this particular volatility of the market to add into your equity portfolios. And lastly, just related to this capex, we always say we need to buy the domestic commodity company like cement in the portfolio. But unfortunately, when I look at cement and when I look at where cement goes, so 50% cement goes into infra and 50% cement goes into real estate. And real estate, it is not firing from all cylinders. There are a few pockets. Nilesh Bhai also was talking about that. And that is where the demand is around 8-9%. But the supply is very high because all the companies are looking to double their capacities or to increase massively. So the supply is around 13%. So there is a mismatch between demand and supply. So now where to target and focus on this government capex? So there is a big capex in cement, but unfortunately, buying an original equipment manufacturer, which is the direct manufacturer of cement, may not help now. So you need to look back, look at the company which is providing some major materials to all these cement companies. And that is where what we have identified and taken in our portfolio also recently. The numbers are coming very good. And this is where the money will go now. Because these vendor companies where the market share is higher, for example, there is one company which is in high chrome grinding mills. So those kind of companies which are catering not only to Adani or ACC Ambuja or Shri Cement or Ultratech Cement, they are catering to all. So they are actually the direct beneficiary of the capex. I am sorry, not the OEMs right now because of so much of capacity expansion. Yeah.
Thanks, Amit. That was quite elaborate. Bharat, over to you for your closing comments. Okay. In the meantime, any of you have any questions? Okay, Amit, maybe you have to do the closing comments.
Yeah. So that was a brief about the budget, about the government Saptarishi theme which they have come out with. I think going forward for the coming year, though there may be a lot of volatility because when we are moving beyond budget, the next thing which will come up now is state elections. So there are a number of state elections, and that again is the question with the market that if any populist theme comes out towards the elections, then what will happen to infra. But I think some part of it is answered now in the budget, which is very clear. The GST numbers are improving. And this is where I think this market, amid this volatility, is a market where the declines should be bought into. And this is what the gist we have taken from Nilesh Bhai also. And that is what our house view is. So that's all from our side. Thank you very much for joining us. We will meet again. Thank you.
Thanks, everybody, and thanks for joining it. It was a pleasure having you up here. And good evening, and have a wonderful day ahead. Thank you.